Sun cast a shadow, a digital line is coming over the mountain and over your mind. Double down your Bitcoin, hang on for the ride. We're moving into the future, one block at a time. We're moving into the future, one block at a time.
Welcome to Once Upon a Coin, documenting the ongoing history of blockchain and cryptocurrency. As always, I'm your storyteller, Jason Cassidy. Today's story looks at one of the earliest companies in cryptocurrency, a mining startup that in a very short amount of time ended up changing the Bitcoin mining industry forever. This is the untold story of ASIC Miner. We have to go back to the summer of 2012, which is when our tale begins. A group of friends in China formed a company called Bitfountain, which focused on Bitcoin mining in just about every format available. They enjoyed some initial success with these mining ventures, which led them to the decision to go ahead and take things to the next level. They wanted to build a mining fleet that would be able to make a serious splash in the increasingly competitive Bitcoin mining industry. An ambitious endeavor for anyone, however, in this time period, if you dreamed big enough, just about anything was possible. So, led by their elusive yet talented founder, who went only by the online moniker Friedcat, Bitfountain formed a subsidiary called ASIC Miner and began putting together a crypto-centric crowdfunding campaign to help turn their dreams into reality. By the time August of 2012 rolled around, the team was ready to go to market as they announced the company and its equity sale to the blockchain world via the Bitcoin Talk Forum. The response was more than anyone could have imagined. Considerable interest from the community was shown, which led to ASIC Miner being able to raise a healthy amount of money to fund operations early on. Shares were sold on the, at the time, very popular GLBSE, or Global Bitcoin Stock Exchange. And this was a place where a Bitcoin-related company could raise capital by issuing bonds or stock to the public in exchange for Bitcoin. You could purchase any number of shares at a price of 0.1 Bitcoin per share. 5,000 or more shares got you a board seat, a position many investors coveted to gain more insight and control over their investment. The funds were being used to build new ASIC mining chips, ASIC standing for Application-Specific Integrated Circuit. In essence, ASICs were the next evolution of Bitcoin mining, and ASIC Miner wanted to capitalize on this new trend by being one of the first to market with a well-built ASIC machine. ASICs were a big step up from what the mining industry previously looked like. Things had started off with CPU mining, then advanced to GPU mining, and finally ended up with FPGA. The Bitcoin hash rate at one point was so low, in fact, that you could actually mine with a good old-fashioned personal computer and get Bitcoin at a profit. Earning more Bitcoin than the total cost of electricity spent to mine them was the name of the game. And with the advent of ASICs, it now meant that one could throw considerably more hash power at the network and in turn, fetch a larger percentage of the available Bitcoin each day.
Satoshi Nakamoto maintained Bitcoin Core between 2008 and 2010. Satoshi separately recognized that specialized hardware would eventually support the network. Late 2010 to early 2011, GPU miners appeared in the forums, tweaking the firmware of graphics cards to beat out CPUs at 600% comparative efficiency. They illuminated the question, why are we not using hardware customized for Bitcoin?
ASIC Miner was now front and center for this revolution in Bitcoin mining, as they quickly got to work producing what they hoped would be the world's fastest, most efficient ASIC mining machines. They were now in a very real arms race against the handful of other companies that were hitting the ASIC scene like Butterfly Labs and Avalon. The longer it took to get the Bitcoin mining machines active and pointed towards the Bitcoin network, the farther back they'd fall as other miners scooped up those precious Bitcoins. ASIC Miner's first release was their Generation 1 block Eruptors, with the biggest hit in the series being their USB-based version. A small yet, for its time, powerful little piece of mining hardware that could fit into the palm of your hand. The other offerings in the series included the BE100 Cube and the BE100 Blade, both of which sold like hotcakes as well. Understanding that in the Bitcoin mining game, time is money, the company quickly moved to solidify their next generation ASIC chip design and send it off to the foundry for mass production. And by the winter of 2012, the company had announced that the foundry had begun development on their Generation 2 BE200 ASIC mining chips, set to be delivered no later than the summer of 2013. As the calendar flipped over to 2013, the sales from their Generation 1 block Eruptors were making ASIC Miner enough money to scale up in a big way in a short amount of time, ordering yet more chips to be fabricated for their now highly anticipated BE200 ASIC chips. These chips would need to be packaged into a physical mining device, and this is where the real complications arise in building the perfect mining machine. You see, just like a PC or a laptop that's built to do a lot of serious work, mining machines also generate a lot of heat and need ways of being kept cool as they process countless amounts of operations. The trick is maximizing the physical space you have to include enough fans or other means of keeping the machine cool, lest it overheat and break down. Too much heat being generated would eventually lead to a degradation in performance. Doing this with as compact a device as possible was the goal, as the more compact and less bulky the device, the easier to deploy by the thousands onto shelves in some faraway, temperature-controlled server room.
ASIC manufacturers over the next few years had to consider somewhat unique chip architecture to make SHA-256 and SHA-2 encryption the sole focus at a hardware level. Butterfly Labs had also set the expectation that ASICs could be industrial or consumer grade for use in the home. Demand had to be met for uninitiated users and industrialized enterprise scale. Power consumption per unit and cost to manufacture were the main forces driving the divide in hardware offerings.
ASIC Miner felt that they had the ideal design, and this confidence trickled down to the Bitcoin community. Virtually everyone in the know now was waiting with bated breath for the arrival of the company's Generation 2 BE200s. Over the course of the year, the company worked tirelessly to unload any remaining Gen 1 stock in preparation. And while this was unfolding, ASIC Miner shares began to inch up from their initial 0.1 Bitcoin IPO price. This is a good point in the story to mention probably the most attractive aspect of owning ASIC Miner shares. They paid dividends in Bitcoin, and boy were they juicy. The way this worked was, all the mining revenue that ASIC Miner made, minus a small portion to cover costs, was sent in the form of a dividend to shareholders on a weekly basis. So essentially, ASIC Miner would mine a ton of Bitcoin each week, and then send those Bitcoin back out to shareholders. The more shares that you owned, the larger percentage of the mined Bitcoin you'd receive. And because the parent company, Bitfountain, owned a large amount of the outstanding shares, they had more than enough revenue via dividends to continue to grow their subsidiary in ASIC Miner. Where this gets really interesting though is when one factors in just how much Bitcoin the company was bringing in. Remember, they were deploying increasing amounts of hash power onto the network on a daily basis in the form of ASICs. And as their slogan said, ASIC Miner had entered the world of ASIC mining by quite literally inventing it. This all led to creating an environment where the company kept taking over a larger portion of the Bitcoin network measured by hash power. And the more hash power, the more Bitcoin coming in. ASIC Miner was now mining thousands of Bitcoin a week, so if you had a large amount of shares, you were receiving some truly jaw-dropping dividend payments. This is a part of the story that I can personally attest to. You see, when I first got into cryptocurrency, it was the mining aspect that probably fascinated me the most. ASIC Miner was a nice way to get access and exposure to mining without having to do all the heavy lifting. I clearly remember being outside gardening one sunny afternoon when I heard my phone alert go off. Every Wednesday at 2 p.m. Eastern was dividend time. So I rushed into my house to check my Bitcoin QT wallet, and when I saw the amount, I basically shit myself. You can probably guess now what happened to that 0.1 Bitcoin share price. Yeah, it went supernova. By the summer, the price had soared to 1 Bitcoin a share, which meant a very sweet 10x return for IPO investors, and that's before factoring in the crazy amount of dividends being received each week. As bigger and bigger dividend payments came out, word quickly spread about the chicken that laid golden eggs, and seemingly everyone in crypto at the time was now trying to get their hands on these shares. Prices once again moved up as 1 Bitcoin a share became 2, then 3, then 4, and finally 5 Bitcoin a share. The company was making millions of dollars a week with minimal expenses. And before too long, word started to spread that ASIC Miner was the first $100 million Bitcoin company without a website. It was a head-turning story. Despite some early delays on the BE200 chips, by all accounts, the company was doing incredibly well. It seemed like everything was going great for ASIC Miner. The idea, the timing, and the implementation. But as fate would have it, this actually marked the peak of the company's success. It's around this time that a Mount Vesuvius level disaster was unfolding, shaking the very foundations of cryptocurrency. The Mt. Gox collapse created a cascading effect that was felt by many sectors in crypto, including the mining industry. And as the price of Bitcoin crashed, the profitability of mining was thrown into a blender on high speed.
You buy Bitcoins through an online exchange, and one of the biggest, Mt. Gox, unexpectedly shut down today, owing hundreds of millions of pounds and prompting the sharp fall in the value of the currency.
Things only got worse as company updates became less common, and their financial statements were slowly but surely beginning to reflect one of a business that was in some level of distress. A seemingly endless amount of delays on the BE200s kept occurring, whether that was for sales, internal deployment, or just receiving new chips from the foundry. By the spring of 2014, Gen 2 hardware was finally showing up at ASIC Miner HQ, being deployed to join the ever-growing mining armada that the company had amassed. Early results on performance were not up to par, but the company promised to have solutions for all these problems in the form of miner software and hardware hacks to help achieve optimal efficiency. But the damage appeared to have already been done. The share price had utterly collapsed from its 5 Bitcoin peak, and the combination of Bitcoin mining hardware that really wasn't all that good at mining, plus numerous delays on getting it to market, created a rather ugly scene. By the time the BE200s were ready for deployment, they just really weren't that competitive anymore. The next thing to go were the weekly dividends, with most reactions to this being unsurprisingly negative. And before too long, ASIC Miner's fearless leader, Friedcat, addressed the public and the company's performance. The end result was the line of Generation 2 chips were poorly designed, and this swing and miss meant that the company now had to put everything in the kitchen sink into a great Gen 3 release, hoping that it could solve the growing list of issues that the Generation 2 line had introduced. The tentative delivery date for the new and improved BE300s was in spring of 2015. Those machines never ended up making it out of production though, because by the time 2015 arrived, the mining industry looked a lot different than it did back in 2012 when ASIC Miner shocked the Bitcoin world with its introduction of the ASIC. By now there were several serious competitors who hadn't flushed a full year of development down the drain with a failed Gen 2 release. Names like Bitfury and Avalon had surpassed ASIC Miner in virtually every facet of mining. And the last to go? Well, Friedcat himself. Because not too long after the bad news had been delivered, communication from him and the rest of the company had ceased completely. Rumors began to swirl about his whereabouts and safety. Had something happened to him? After all, he didn't seem the type to just up and vanish. Those rumors then evolved into hints of internal company strife with a falling out between the founders. Eventually, information made its way down to shareholders that indeed the company had dissolved, with the founders and employees all vacating ASIC Miner HQ. Pictures of empty boardrooms, random desks, chairs, and potted plants strewn across a now disheveled-looking office made it crystal clear that this party was now officially over. Varying levels of disbelief on shock came next as investors wrestled with what they had just learned. In the coming months, more rumors popped up as well, ranging from Friedcat being abducted by the mob to the imminent return of the company after a prolonged sabbatical. As it turned out, none of these things were true in the end, and the mining industry simply had to move forward with the change in landscape as new ASICs were coming out by companies producing much more efficient hardware. This was the end of ASIC Miner. So while the story ends on a bit of a low note, it's actually a really positive one overall if you ask me. ASIC Miner had done something no one could have predicted. A small Chinese startup had taken it upon themselves to completely reinvent the Bitcoin mining industry. And they actually pulled it off. Their impact on mining is etched in stone, with their story serving as a cautionary tale of how just one mistake can be your undoing in the wild, wild west of cryptocurrency. As for myself, I was fortunate enough to see some of the cracks forming in the company and got out before everything had collapsed. The experience was invaluable, however, as I learned a ton about Bitcoin itself, the economics of mining, and what it takes to build a kick-ass hashing machine. And while the era of ASIC Miner is long gone now, they played such a pivotal role in the early days of mining that their legacy will always be relevant when viewed through the lens of the true pioneers of cryptocurrency. I hope you enjoyed today's stroll down memory lane. Until next time, have fun and enjoy life, my friends. I'll be back soon with another incredible story to tell you.